Welcome back, everyone, and welcome to the final session of the day, which is the one I'm sure everyone has been looking forward to the most, which is, of course, the Writers' Panel. My name is James Faulkner. I'm the editor of Master Investor. I'm joined here today by two of my very distinguished colleagues, Victor Hill and Mark Watson-Mitchell. Welcome to the show, gents.
Thank you.
You're all very lucky today.
Hi there.
Because I'm not sure how Victor and Mark's going to feel about this, but I was doing a few sums earlier. I think we've got about 100 years plus of collective experience in the markets between us.
Well, yeah, I'm sure this is true.
For
yes.
What that's worth. Not that we're showing that, by the way. We're all looking very youthful, I think, especially Mark over there with his lovely beard.
Thank you.
Right. I think we can all agree that 2020 has been a bit of a funny old year.
Wow.
It's delivered one hell of a roller coaster ride in terms of the market performance. I just want to kick off by contextualizing the sell-off and the rebound. How does it compare to previous bear markets? And obviously it's not been a normal bear market, has it? Because it's kind of been self-inflicted. So just give us a bit of a flavour, Victor, as to where this one sits in the history books.
Well, from my perspective, things are not as bad as they might have been. I mean, in a way, given what's happened to the economy and given these extended lockdowns and the restrictions that have been involved on economic activity across Europe and North America, the markets have held up very well in many ways. The UK market is a bit of a laggard. And that is specifically because it's a high dividend market at a time when dividends have been drastically reduced. And also there is a lack of really highly attractive, alluring tech stocks on the UK market. But New York has held up very largely. As we know, the big tech stocks have actually profited and have continued to thrive. So there's a bunch of major stocks which account for a very large proportion of the total NASDAQ capitalization, which have powered ahead. And if you held those, you've done very well. Then there's the pharma stocks, and then there's the internet shopping, the Amazons, the Ocados, done relatively well. So there were opportunities over this year, albeit that the London market was extremely tested. Now, come 9th of November, we learnt that Pfizer/BioNTech of Germany had developed the first vaccine which had proven efficacy. And the markets began to snap back to something approaching normality. Gold fell, the oil price rose a little bit. Some of the distressed stocks, the airlines and the retailers, the pub chains and so forth, began to retake some ground after a very bad year. So
do you think 1 week later, the rebound, Victor? Do you think the strength of the rebound, even before we got the vaccine news, took people by surprise a little bit? Because I think back in March we were all kind of panicking, and everybody was predicting this this terrible depression type scenario. But yet stock markets since then have bounced back incredibly strongly, haven't they? Especially in the US. Do you think a lot of people have been caught by surprise by that?
Well, I was surprised at the strength of the rebound on 9th of November. And I think it was very largely based on the triumph of hope over experience, because I don't think that we will be back to normality come Q1, even Q2 2021. I think we're looking at a year more of economic dislocation caused by this pandemic. And therefore, I think that the return to normality is a little bit premature. So, Mark, did you have any view on that?
I think Mark's a little more bullish, aren't you, Mark? I get
Well, yes, I am. I believe that we as a race are an optimistic race, and we as investors are optimistic. And I think the minority are bears and the majority are bulls. So I take the view that business gets kicking when it has to, and it's currently having to do exactly that. But I go back, when your question, James, was, is it like any previous time. I remember 1971, 72, and the market just fell out of bed. I think what was then the equivalent of the FTSE 100, the FT30 went down to 50 odd points, 49 points. You know, wow. And then we had it 81, I think, and then 87. I remember absolutely losing an absolute bundle on Black Friday in October that year. And we've had several market fallbacks. And we had, of course, the almighty one in 2008. But we learn to recover. We find a way of recovering. And, you know, and I think the natural optimism of market investors and companies in the UK actually helps to push the market better. Yes, we had a market that was actually being driven up to 7,700 just a year or so ago, whatever it was, and it's been down to 4,800 subsequently. It's now in the middle of that range, and I see it going better over Q1 and Q2 next year. But that's the market. We've still got a wipeout for corporate UK PLCs in 2020. So you might as well forget the figures and the profits and the sales for this year. Forget them. Look for next year. Where previously sorry, Victor.
You and I go back to the early 80s in terms of our professional experience, and there are innumerable slumps and market crashes that we could refer to. I mean, just in terms of this century, since our careers span 2 centuries, if I can put it that way.
That's true.
If you go back, you know, the Second Gulf War, 2003, I remember having lunch in the city, and the market was just creeping down to 3,000. And we were speculating on how low it might go. That was a major geopolitical trauma. And then you had 2008, 2009, the financial crisis, and you had, you know, absolute Armageddon in the financial industry. But, you know, though I hate the phrase, it's a very dangerous one. This time is different. Why is it different? Because it's entirely self-inflicted. I mean, the economy is on a precipice because the politicians, in their wisdom, and we can argue how well they've responded to the situation, have decided to close parts of the economy down and to confine people at home. So it's not a crisis that's caused by exogenous factors, by the state of the world economy or any intrinsic financial reason. It's really behavioral.
Because of that, because the economy is being kept on life support, as it were, we've not seen the supply destruction on the scale that we would have seen in previous recessions. So presumably there is scope there for quite a quick bounce back once the vaccine takes effect, and people do start to get back to normal, because we've not seen that huge avalanche of bankruptcies or anything, have we yet? Which people were predicting earlier
because
on.
The government has effectively kept the economy on a life support system by pumping money in. You know, that money will have to be found sooner or later. You know, government finances are going to emerge from this crisis in a crippled condition, and the debate going forward will be when and how much to raise taxes, and that's something we've all got to look forward to. But I mean, the economic damage has been obscured by state intervention effectively. That said, we're coming to a point now where a number of businesses, even given the furlough scheme and the other forms of state intervention and subsidy, are deciding that they have possibly no future. And very shortly, the capacity of the economy will be significantly reduced by bankruptcies, by businesses which just decide that they cannot continue in these circumstances. And therefore, we will emerge the other side, Q2, Q3, whenever it might be next year, with a reduced economic base. And unfortunately, that will impinge on growth. So therefore, I know you divide, Mark, the world into bears and bulls, but I just want to be a realist.
Mm-hmm. So
hopefully I'm a realist, but But James's question was about the market, and my basic premise is the investors in the market are bulls. Majority are bulls, and that's what they go for. They look for short-term, medium-term, longer-term capital gain, and they're only going to make that out of a market that's active, and that's what is being generated currently. What we've got, unbelievably, is an unbelievable amount of quantitative easing, which is just extraordinary. As Victor has been saying, at some time or another, somebody's going to come along and say, right, you've got to pay up. And unfortunately, I think it is going to be the Chinese who are going to be demanding a lot of money back from the UK and America, because they own so much of Americans' bonds. They're going to be basically saying, give up or we take. And they've already got control of our power system in the UK. They've got control of so many things still. And they are still a major supplier into the UK of cheaper products, which we in the UK are massive recipients. Anyway, sorry, that's...
Well, this is a massive geopolitical theme, which
do we have agreement? Do we think that we're facing a higher inflationary outlook than in future, given what's going on in the economy?
Well, by rights, we should already have inflation, given the quantity of monetary economics
going on at the moment, aren't they?
So thus far, in the last 10 years since the financial crisis, the deflationary forces have outbalanced the forces of inflation and the increase in money supply associated with quantitative easing. Now that could tip very suddenly. I don't think it's going to happen immediately, but looking, say, 2 to 5 years out, I think that the environment could change very dramatically. And I mentioned to you earlier, one possible scenario is if the Chinese suddenly decide to revalue the renminbi. That will definitely destabilize the entire international financial system. Interest rates will suddenly trend upwards. That will have huge consequences for government finances. At the moment, they can borrow almost for nothing over long term. That will change. And therefore, a lot of state finances will become unsustainable, not least here in the UK.
Buy gold.
Funny though, isn't it? Because
it's a hedge. Gold is a hedge.
Totally.
It's an insurance policy.
Yeah. On that basis,
but you're not going to get rich in the short term sitting on gold coins.
No, not at all.
Yeah, the wind seems to have come out of gold sales since the vaccine was announced, doesn't it, as well?
Well, it had moved quite a lot, hadn't it? I remember writing in the magazine. What was it when it was 1,014, 1,400, 1,200, 1,400. Yeah, not that long ago. And also silver at then what, $12, $15, $15. And, they've had a massive kick up. No market goes on forever. And it's like one of my stock phrases, nothing in life goes in a straight line. Love, sex, money, bank accounts, they all go up and down. And this is exactly the same in markets, whether we have a FTSE we're looking at, or the renminbi, or whatever. So just got to try your best.
Well, when the markets are distressed, when the markets are nervous and in a state of great anxiety, obviously gold tends to go upwards. It's a safe haven, effectively. Yep. When the markets can see a way through, the gold price will attenuate, and that's effective. So I said last week, effectively, we're at the end of the beginning, but it's not yet the beginning of the end of the pandemic crisis.
So with that in mind, then Victor, presumably, I know you're kind of quite bearish overall, but presumably you're still quite bullish on this kind of stay-at-home type technology plays, the ones that we talked about in our report back at Easter time.
Well, indeed. I mean, we predicted the rise of Zoom, didn't we, way back in April? And the share price virtually tripled in the space of 6 months. And then come November 9th, with the announcement of the vaccine, the Zoom price tumbled. Well, I mean, I hesitate to call markets silly because the markets are always right, aren't they, Mark?
This is
but
proved.
you know, that doesn't make sense. I mean, the prevailing stock price is the correct price, isn't it? You know,
always, totally right. The market always knows better. You think you do, but
it's just
the
it might
market
move,
knows.
and if you can anticipate its movement, you can make money.
But presumably, Victor, given what you've just been saying about debt, surely eventually we have to see higher interest rates, and some of the companies that have benefited the most from low interest rates are the technology companies, aren't they? Because of the way that, you know, discounting is, you know, the discounted cash
yes.
flow, the ones further out into the future are the technology companies. So that the interest rates have a much bigger impact on the valuations of these high growth tech companies.
Well, all relatively young companies are principally financed by equity. As companies mature, so they become more financed by debt, and they as their earnings volatility declines, so they become highly leveraged. You know, like the big industrial plays on the FTSE 100. So you know, this has been a great time for venture capitalists, for people who get in early to high tech companies which have huge growth potential. And I stress it's the VCs that really make the money, because by the time they come to market, often the huge uplift has already you know, been expended. So we saw, yes, you know, Lyft and Uber and people like this, you know, which really are not proving to be particularly attractive equity investments, even though they're supposedly tech.
And Mark,
yes,
what sort of investments might we be looking at, you know, that from your portfolio of companies that you cover, when we see the economy potentially slowly but surely reopening? Because I think quite a few companies that you cover probably will benefit, you know, quite substantially from that reopening trade, won't they?
Well, as always, I like value. I can't get my head round these technology stocks where it's spoofing to raise money. I've just seen another one this morning, which I cannot see. To me, the value is about £2 million, and it's actually valued at about 40 million. They haven't made a penny profit. They're losing money hand over fist. They've just raised a chunk of money this morning at a price probably 20 times higher than I would ever pay for it. And it's staggering. It's scary. I won't say what the company is.
Well, it's true, Mark. You're right that a lot of people are buying into the narrative rather than to the cash flow or prospective cash flow.
Yes.
I mean, if it's a good story, people tend to go for it. And
yes.
This is the problem. We're living in an age of stories. You know, the equity markets themselves have become effectively sort of Netflix videos and part of the entertainment industry. That said, if you can identify really innovative, revolutionary technologies where the market participant has a potentially dominant position, I think you really are looking at potential. And one of those that I have identified is Tesla. Not that our colleague Evil will approve of this, because I know he's still short. But you know, it's more than a story. It's an extremely dominant position with a technological edge, and that translates into a rising stock price.
But again, so the Chinese are in control. Again, the Chinese are in control.
Well, I'm not sure if they're in control, but
well, okay, who's making them?
Yeah, Tesla is one of the very few Western corporations which has established a manufacturing facility in China, which it owns 100% without any Chinese participation.
So no products, no Chinese products going into the Chinese manufactured cars?
Well, I don't doubt that there are Chinese
Sorry, I'm only winding you up. I'm only winding you up.
But and of course, the Chinese market for electric cars is absolutely massive. I mean, and that's why there are a lot of people. Yeah, but you know, we can't get away from this. You know, this huge black hole that is the Chinese economy, that is sucking everything into it. And in my piece this morning, James. I was talking about how, it's all very well to establish the UK as a hub for the manufacture of electric cars, but who is making the batteries? I mean, at the moment we have Nissan in Sunderland making electric batteries for their own cars, the Nissan Leaf and so forth. But there are no new battery companies. So we will actually end up being more dependent on China than we were before. So
what about the whole corollary that comes with the electric car revolution, Victor? Because I mean, we can talk about the impact on the oil price, but also what about the impact on other commodities such as nickel? That's a really big factor in electric car battery production, things like that. What's the panel's view on the outlook for a lot of these commodities that have been, in recent times have had a really bad time of things?
This whole issue about the essential elements that go into lithium-ion batteries is going to be a huge strategic headache for years to come. I mean, and not only is it lithium and nickel, but it's all kinds of other so-called rare earth elements which are in short supply. And they tend to come from countries which are, shall we say, not the most politically mature. So Democratic Republic of Congo, Peru, Paraguay in South America. These minerals are mined, by the way, under extremely adverse conditions. And there are all kinds of issues about modern slavery, child labor, about health and safety at work, to which I'm afraid we have already, turned a blind eye to some extent. So we're going to hear more about that. Moreover, when these lithium-ion batteries get to the end of their working lives, they have to be decommissioned and they cannot be recycled. And they're very dirty, nasty things to try to bury in the ground. So there is a residual pollution problem associated with them. And for those reasons, I actually think that what we're going to see is that hydrogen is going to, as it were, come up from the rear and become the dominant technology for vehicular transport. And hydrogen is so inherently clean. The problem with hydrogen is that you have to expend electric power in order to create electric power. And so far, the input-output ratio has not been particularly favorable. However, that could be about to change because there are various technologies which are at an early stage, which will actually revolutionize the production of hydrogen.
And the UK is the world leader in that sector, isn't it, Victor?
Well, there are one or two companies which are doing amazing things. One of them is Powerhouse Technologies, which has been an exhibitor at the MI show on, well, very, very consistently, and which has featured at some of our seminars. And they have a proprietary technology to turn waste, burning plastic and other household detritus into hydrogen. And that's very promising because it's win-win, because it's waste disposal, which I know is something you like very much, Mark.
Love it.
And it's also energy creating. So
great, it's a cycle.
I think there's huge mileage in that.
Yeah.
By the way, indeed, this whole cycle, which is what we need to do to mimic nature, Mother Nature herself, works in cycles. Everything is recycled perennially. And another source of rare earth minerals, by the way, is North Korea, would you believe, who are sitting on huge reserves. And that's possibly one reason why Mr. Trump was so interested to strike a deal with Mr. Kim. But perhaps we won't know for some years what really happened.
On the subject of waste recycling, Mark, I think you'd like to talk a little bit about Augean.
No, well, I two favorite stocks of mine currently are Augean, AUG, and Renewi, RWY, and they're both massively in the waste market, and they are both recovering after hassles. I mean, Augean has a major hassle with having to pay a landfill tax, and they believe, and it is being proven, to have been a tax that HMRC should not have imposed upon them, and they are gradually going to get their money back. They're owed about 40 million, and I think it's a tremendous company, Augean, AUGEAN, and its shares about 180, 590 pence. I see them 230, 250, easily 300 pence. It is just a very, very interesting situation. And the other stock in the waste market is Renewy, which is actually based in Belgium. And they take waste products, just as Victor was saying earlier on, they take waste products and they turn them into product. So they are massive collectors of waste in Europe and also in the UK. And they are literally using that waste to create products which are then being recycled back into industry. And I love it. I mean, Renewy has had a bad year. Their results for their turnover, I would expect to be relatively around 1.7 billion pounds, or in fact euros in this case, and they will probably see their profits reducing from about 50 million to 22, 25 million in this current year to end of March. Then next year, I see them making 46, 50 million, and the year after that, 76, 79 million. So, and I think that's bigger profitability than it's made previously, which is why I go back onto forget the figures that we've been seeing in 2020. It's basically what we've got to do is see the anticipated figures for 2021 and 2022. So we're going back up to the old 18-month cycle, the old spin of seeing what profitability, what sales are going to be in 18 months' time, and then is it of value? So I'm not talking in 25, 35 times earnings. I'm talking about stocks which are on 6 or 7, 8 times earnings, 10 times earnings. The risk at those levels is not high. And they're still going.
One of the interesting things about stocks like Augean as well, Mark, is that it's kind of like one of those perennial companies, because obviously, you know, everybody needs waste disposal, whether we're in a recession or not. And I think similarly, I think, Victor, you're quite bullish on healthcare still, aren't you? Because that's another one of those industries.
Yes, I am.
That, you know,
can I just add to that those comments about the waste management sector? Waste to energy is a much maligned sector because it involves those horrible things, incinerators, which is a word which seems to get everyone climbing up the wall. But in fact, it's an extremely efficient way of disposing of unwanted waste, and it actually it results in the generation of energy and even some byproducts, including building materials. So there are certain companies active there. I think Persimmon is one, and I happen to know that a number of large institutional pension funds are investing in waste to energy. Sorry, James, what was the question?
No, I was trying to steer you back onto healthcare, given that yes, the prospects are good no matter what, almost. You know.
Yes, this you know what. I hope I won't get into trouble by saying this, because I'm absolutely not an anti-vaxxer, and I despise the anti-vaxxer movement. That said, I do hope that we, the public, will be given some choice about which vaccine that we are administered with, whether it be the Pfizer one or the Moderna one or the Oxford AstraZeneca one. And my own preference personally would be for the AstraZeneca one, for a number of reasons. Not that I'm a medical expert at all. I doubt if we will be given a choice. But the interesting thing that the Pfizer-BioNTech vaccine and the Moderna vaccine is based on this messenger RNA technology, which is actually very innovative. No previous vaccines have ever worked on this medical technology. Now, although this may well turn out to be a very effective vaccine, and we don't know yet conclusively, albeit it's going to be expensive relative to the AstraZeneca Oxford University vaccine, this technology could turn out to be a game changer in terms of cancer treatment. So what I'm saying is that any company which is actively developing mRNA therapies is likely at some stage to come across with revolutionary medications for cancer treatment. And we're looking at obviously BioNTech, which is this extraordinary German outfit, which is only 10 years old, founded by two scientists of Turkish heritage. There are other companies like Teva, there's Moderna, and so forth. So I'm very excited about breakthroughs in medical technology, which will emerge in the next 10 years. Do you want me to talk about the other sectors that I'm interested in, James, or do you want to just run with that for a moment?
Victor. I think we're going to kind of round up now with some top
Yes.
tips to finish off, so go for it.
Sure. Anything that's related to computer security, anti-cyber hacking, and ensuring that we are immune from external attack on our computer systems. I regret that one British company which was preeminent in that field, which was Sophos, has been taken over by an American rival, and unfortunately that's a theme right now, that a lot of middle to large size UK tech firms get taken out by American counterparts because of the deeper capital markets that exist on the other side of the pond. And the other sector which excites me is anything to do with data crunching and data mining. And there have been two IPOs in the last quarter, of which Palantir is a very interesting company, definitely with close connections with American federal agencies. And there is Snowflake, not a name I would have chosen myself, but that's doing great things with data, and the share price has been rocketing. So data mining, cancer therapeutics, waste management, green technology, all these thematic trends, I think, have huge potential.
And Mark, I think a lot of those stocks that Victor mentioned, you probably wouldn't touch them with a barge pole, would you? So give us something a little different from your stable of companies.
some of them I would. My big liking, apart from waste and going through the motions, is annual recurring revenues. I think the companies that need watching are the companies with increasing ARR, and then as they build up, it means that they can go up and expand their business. So they know that they've got 40, 50%, 70% of next year's turnover already in the bag. So that means that they've got a base upon which they can spring their capital into investing more and building up, and also going out and acquiring other companies at cheaper ratings than their own. So ARR, I think, is a very important element. If you're looking at stocks, especially on value stocks, I always go on value. I think it's what I can actually see, what I can actually feel, not the spoof that is created by the marketplace.
And gives a couple of examples of stocks with really good recurring.
Oh, crikey, I've got so many. Yes, well, crikey, that's a good question. Literally, there are so many. I like Roslyn Data. I like, what else am I liking currently? One company I have liked, the way it's going on recently, is the Knightsbridge business agency business called K3C Capital. And it's brilliant. It's just going and going and going. And that's because their earnings are increasing, their business is increasing, they're buying good companies to tuck into their fold. And in doing that, they are then increasing their earnings. And I love that. That's standard business, that's standard market. Not the spoof of the very high tech. I'm sorry, Victor. We must sit down sometime and have a really good old natter on this. But I do like feel a company. It's like when I'm going off and drive, well, lockdown permitting, when I'm actually driving around the country and the roads in the country, whether it's trunk roads, whether it's the A roads, M roads, whatever, and I can actually see the wagons taking up goods you know, the logistics firms which are literally carrying people's products. And I love that because I can feel it, I can see it. That's why I'm not particularly interested in companies in the States and Australia or wherever, because I can't see them, I can't feel them. Whereas I love to go off and see a business. There's nothing I enjoy more than seeing a widget manufacturing business and seeing how they take molds and they screw these bits of metal and they, oh, I love it. Sorry, I'm going to tear it off here.
Okay, I think we're coming to the end of the session. So two very different outlooks on investing there, I think. Maybe to be continued another time and day.
I look forward to that.
Thanks for watching, everybody. Take care, and we'll see you next year.
Thank you.
Thank you.
So that's the end of this year's show. We hope you've had a great couple of days and picked up plenty of useful ideas for your portfolios. All of the main stage sessions and our library of fantastic on-demand presentations will remain accessible on this platform for the next 4 weeks or so. So if you've missed anything or want to hear something again, you can log back in and access the recordings. All that remains is to say a huge thank you to all of our sponsors and exhibitors, and not least to all of you, the audience. We hope you've enjoyed it, and we'll be back next year on the 19th of June with a bit of luck in physical form. You can reserve your ticket right now at masterinvestor.co.uk. But until next year, look after yourselves and best wishes for a healthy and prosperous 2021. Thank you.